Welcome everybody, and thank you for joining us today. My name is Murray Anderson, look after Prescient's retail business. This is really going to be our first webinar for 2024, but in fact it's a reflection of what took place last year, 2023. We'll review our multi-asset portfolios, and of course we're going to cover the global macro backdrop that we are facing the year ahead. We'll provide insights into our views, and obviously then an insight into how we'll be managing portfolios going forward. So to introduce the panelists with me today, Bastian and Rupert. Bastian's our Chief Investment Officer, and Rupert looks after our multi-asset portfolios. So welcome to you, gents, and we look forward to engaging over the next few minutes. Thanks, so firstly, maybe to you, Bastian, let's talk about 2023. And so there were some surprises. It was an interesting end to the year. Maybe give us a sense of how you saw the year, and particularly then give us a sense of what to expect from the year coming at us at 2024.
Thanks, Murray, and yeah, thanks everybody for joining once again. Welcome back, so to say. I guess the most interesting part for us at the end of 2023 was obviously what we call the Fed pivot. So finally, the outlook towards lower interest rates, I guess that was really, really key. Supported markets quite dramatically in the last quarter, and that also helped our performance quite nicely. Something we did to some degree anticipate, because we saw inflation coming down through the year, and that actually played out in the end quite well. So for 2024, what will be the drivers? In our view, once again, what is global growth going to do? What is the inflationary outlook going to be? And with that, what is the Federal Reserve and generally global interest rates going to do? Our view is interest rates will come down. More detail on that just now, but we must be aware that we are looking at these factors during a period where there's elevated geopolitical uncertainty, plus a period where asset classes generally are globally quite pricey.
So a lot to consider. I mean, I think if you look at it, you've got interest rates, inflation, geopolitics, as you talk about, is going to be a significant consideration throughout the year. We know valuations have looked extremely high, but I guess typically the main consideration is global growth and what's going to happen from a growth perspective. Do rates remain at these elevated levels, and what does it do ultimately for the drive of asset prices?
Yeah, let's start with global growth. Good point. We do also, as you say, I think that at present that will be the key force this year. What is happening to global growth? And global growth, in our opinion, doesn't really look that terrible. So we use the Prescient economic indicator. We track global growth, or US growth in this instance, in real time at 2% real, which isn't super exciting, which isn't amazing, but it doesn't hint towards a recession either. What I will say, though, is that US growth, or US GDP, is quite split, which is unusual. So we see a very strong consumer still. We see strong consumer confidence, but basically everything else is already partly in recession, especially the producing sector is doing really, really poorly. We must also be cognizant that we do think at this point in time risks are tilted to the downside. So if we look at the Prescient economic indicator in detail, we will see exactly what I just explained, that global US growth in this instance is quite split. So just to recap, the factors which we track to understand US growth in detail, they go across a wide array of indicators. We're looking at basically consumption, domestic consumption, export sentiment, GDP itself, financial conditions, global income, personal consumption, again from a different angle, labor market conditions, economic conditions, etc., etc. And then all these time series we can obviously split out quite nicely to understand the details more, to understand basically more detailed where growth is coming from. It's quite key in terms of forming a forward-looking view on global growth. This chart is just a regression. On the x-axis you can see the Prescient economic indicator, on the y-axis real GDP. You can see that the regression has a high degree of explanatory power, just meaning that the indicator which we looked at above, or the indicator which we are creating, actually works. Okay, so now what is the indicator telling us? Dark blue line on this chart is US GDP, and then the light blue line is us tracking US GDP in real time. What I'm going to do is I'm going to zoom in a little bit further and further and further until we really see the details. And you can see on the right-hand side of the chart, there's soon a small yellow dot emerging, which is our real-time nowcasting of US growth. And if I just hover over that, you can see that we are 2.02%. So this data set or this prediction works really, really well, as we've seen above, and it tells us what to anticipate. So right now, no recession, no falling off a cliff of US growth, but also nothing to get too excited about. I mentioned earlier that we need to see where this growth is coming from, so I want to basically split that. We do it through time in this chart, but it's a little bit small. So I just want to focus on the last observation. If you focus on the bottom of the screen, you can see this is the zero line, and the positive contributors are really just personal consumption expenditure and sentiment, which is consumer sentiment in this instance. The negative contributors are basically everything else. And the biggest negative contributor is economic conditions, which is basically everything linked to the producing sector. Also interesting to see that the labor market is actually contributing negatively. So that highlights that, yes, the labor market is still sufficiently strong, unemployment is low, that's what's supporting the consumer, but the labor market in itself doesn't appear to be very inflationary anymore.
Okay, Bastian, thanks. I mean, looking at what the Fed has been concentrating on, it's the labor market. It's about this inflation consideration. But now you start to see industrial production slowing. So you've got these two tilts to the economy. You've got the industrial production on the one side, it's maybe softening a little bit, but you've still got the strong consumer. And obviously, the biggest contributor to US GDP is this consumer. Do we not expect to see consumer weakness coming into the US market?
Yeah, that's a good point. And exactly as you say, Mari, 67% of the US economy is driven by the consumer. And that's what keeps going. But it can only go so far. So why is the consumer still strong? And for that, we have to, as you rightfully indicated already in the beginning, we have to look at the US labor market, which remains strong, but which starts to weaken. And from there, the key question is, if the labor market is so strong, why is that not inflationary, or why is that not leading towards high interest rates for long? And our take is really that it's not. So if we look at the labor market a little bit more in detail, we'll actually see the slowdown. We'll see unemployment still very, very low. Nothing is rolling over yet, but it is slowing. So it's actually interesting to see that inflationary pressures from the labor market, as often claimed, are nothing which we are actually tracking. So we like to start off by looking at the labor market by zooming in on this heat map. This heat map basically is showing on the y-axis different employment metrics, like all the way from unemployment through wage growth to basically hires and quits or total job openings. And then we color in red if the normalized number is extremely negative, or in dark blue if the number is extremely positive, or in white if the number is quite neutral. So you can see this big area of the great financial crisis, everything negative. You can see COVID here, short but very deep shock to the labor market. And then over the last couple of months, now 3 years actually, most of the indicators have been in dark blue. So being very, very positive, hinting towards a very tight labor market. But what you can clearly see is that some of the indicators are moving from dark blue more towards white. As an example, non-farm payrolls really coming off their very high numbers. We can look into non-farm employment also coming off quite significantly. Quits, which is basically people leaving their current job to go for a new opportunity, starting to come down from the dark blue into the light blue. And then new hires actually moving from dark blue through white all the way into the red. So the labor market is cooling on quite a few metrics, and that just generally is a positive thing until it goes too far. Let's look into employment directly. I'm going to switch off the labor force participation rate because it's so heavily driven by structural forces. Going to switch off the employment to population ratio and really focus on the prime age participation rate. So the prime age participation rate is focusing on employees at the age of 25 to 54. So we have totally eliminated any structural shifts. And if you can see on the right-hand side that the prime age participation rate has really started to roll over. So participation in the labor force is starting to slowly but steadily really drop, which is a clear indicator that the job market is cooling. Let's take this one step further and look into job creation. So our most famous indicator here would be non-farm payrolls, very volatile on this big scale. So I'm going to switch it all off and just bring in the 12 months moving average. 12 months moving average of non-farm payrolls. You can see post-COVID steep recovery, but now we are heading down steadily, all the way to a quite normal level, and the trend continues. And so on, the story continues. If I look into more metrics, I can also look into, not going to look into job openings, but I'm going to focus on the hiring rate. If I focus on the hiring rate, so how many new hires are there every month, you can see that the hiring rate also is actually dropping quite sharply. So US companies not as keen anymore to take on new workers. And all of that just clearly obviously points to a cooling labor market. Is all of this inflationary, or have we reached a period where there's a structural undersupply of labor? We actually really don't think so. Nothing is pointing toward that. So if we look at wage growth, probably the most important indicator when it comes to the inflationary outlook or the risk of inflation being sticky, you can see that wage growth keeps on coming down, steady downward trend, and it hasn't stopped. So inflation really doesn't seem to be the problem, and I want to show one last chart on that actually, taking it a step further, looking at unit labor costs. So unit labor costs are basically measuring how much costs are there per employee in relationship to the output generated. So now we're also adjusting for increased productivity, which we've seen quite dramatically post-COVID. And you can see that US unit labor costs have really dropped sharply to a level which is actually below pre-pandemic levels. So long story short, the labor market is cooling, it's not rolling over. It points towards a Goldilocks scenario, which is all good, and we shouldn't be too worried about wage growth and wage growth being inflationary.
Okay, thanks, Bastian. It was a great explanation. So the labor market, I think the Fed's doing its job. The labor market's not too much to worry about there from an inflationary perspective, but we've been seeing these perpetual high interest rates in the US. So if it's not too inflationary, there's always, last year there was this big question around recessions, are we going to see a hard landing? But given what you've just demonstrated, what's the outlook for interest rates in the US?
Yeah, it links to global growth and global inflation, right? So what have we seen? We've seen that global growth is cooling, but it's not rolling over yet, so no recession. We wouldn't anticipate that immediately. And what's happening to inflation? We've just demonstrated inflation is coming down quite sharply and continues its downward trajectory. So with that, we definitely have room for low interest rates. So we actually at present are laying out three scenarios if you want to. Our base case really is that from an economic point of view, quite positive outlook, that interest rates are coming down, at least later this year. Latest they will be lowered, but not necessarily on the back of a deep recession, but more on the back of slow growth, low inflation, and the Fed's ability to bring rates to a normal level. What would be our alternative scenario? Interestingly, not that interest rates be higher, stay high for longer. Our alternative scenario would be, again, lower interest rates, but now on a more negative, or with a more negative driver, that maybe global growth eventually does roll over. We do hit a recession, and the Fed cuts because of that. There's obviously a tail risk also that inflation will remain more sticky, but the data right now really doesn't support that, so we wouldn't attach too high a probability to that scenario. So long story short, rates to come down, that's supportive. Are we overly optimistic based on all of this? No, not actually. We're actually globally taking a cautious stance, because from an economic point of view, what I explained is a little bit of a Goldilocks scenario, I'll say that, but we are entering that period during a phase where actually asset classes are expensive, financial conditions are tight, global sentiment appears to be quite, quite complacent, especially with all these lingering geopolitical risks. And again, 2% US growth is not bad, but it's also not very, very exciting.
Okay, Bastian, you mentioned geopolitics. Probably this is the thing that's on everybody's lips as well, outside of interest rates and the economic factors. But geopolitics is playing more and more of an important role in the direction of markets this year. We've got, a significant war that's being playing out between the Ukraine, and Russia. And we've also got, in the Middle East, more turmoil and continued. This is going to affect markets. What are your views around where and how geopolitics is going to play out across the world, and then particularly affecting asset classes?
Yeah, I want to start by explaining how we systematically approach that, because with a systematic investment approach, we often get the question, how do you deal with geopolitical risk? And the answer is we really don't like to focus on making predictions on who's going to be the next US president, or is the war in the Ukraine going to escalate, or who's eventually going to win that war, because the reality is we don't know. As an example, and even if we would know, you don't know the, how must I say, the reaction function of markets towards it. I'll give you a perfect example. We all panicked about a Trump re-election now. That seems to be one of the larger concerns, it's one of our larger concerns as well. But last time Trump got elected, markets panicked just to rally the next day. So the way we approach this is more, we look at what are the implications of a Trump re-election, for example, on business confidence. What are the implications of potentially a Biden re-election on consumer confidence? But then also factors like we look at profit margins, for example. How are profit margins impacted by geopolitical risks? They actually are. Higher oil price will immediately impact profit margins if the crisis in the Middle East escalates. Or as an example, we could also look at Trump being re-elected and cutting tax, which will immediately elevate profit margins and bring actually valuations down. So from that point of view, we really like to go with the measurable facts, with the indicators where we can track the data instead of just issuing views on how bad a geopolitical crisis can be. Nevertheless, we obviously do form views on these crises, and we have a dedicated set of which crisis we think is most severe over the next 12 months.
Okay, so elections around the world, sort of 60 countries going into election. I think for the populations around the world, it's a very interesting time. People are probably going to step up and make their voice heard. So we talk about probably the biggest one being the US. Maybe just speak a little bit more around what effect these elections will have globally, and again, from a economics perspective, it's going to have an impact, but how do we dial this into how we manage money?
Yeah, that's difficult. So basically, as I just explained already, looking at the measurable data, looking at consumer confidence, business confidence, investor sentiment. You can also look at public sentiment through Google Trends analysis. We love alternative data to be close to that. And then again, also impact on valuations, profit margins, economic surprises based on what is happening in elections. So a lot of ways actually to do that statistically solid. No need to come up with wild speculations. I do, though, want to give a little bit of an answer what we do see as the key risks. You mentioned a lot of elections are happening this year, which is quite remarkable. I think half of the world's population is going to elect. If you drill one level deeper, quite a few of these elections are not going to be that impactful, which is quite interesting. So that it's potentially overstating the issue a little bit. But the one key risk which we see as the most dominant one this year is actually the US election. Not so much that we are panicked about the direct outcome, more about the ripple effects, because the US economy, or the US democracy in this instance, is already in crisis mode. So we can't be too safe about the peaceful handover of power. Sounds quite doomsday-y, but the reality is we've seen similar events before. So what happens if Trump gets elected, and how is he going to grab power? Or if he doesn't get elected, what's happening then? And also be aware of the correlations. Like the outcome of that election will heavily impact the two other big crises, which is the war in Ukraine and the war in the Middle East. And they obviously will be heavily impacted by the outcome of this election as well. So with that, we think that's really the one key political risks to focus on this year.
Thanks, Bastian. It's good to get a view on the global macro front. Turning to Rupert, who's the head of our multi-asset portfolios, and particularly in the context of this discussion today, we'd like Rupert to talk about his positioning in the portfolios over 2023, and then obviously what to expect coming out of certainly the global backdrop, and what we spoke about, the expectations for 2024. So just to remind the audience, our Prescient Balanced Fund is target CPI plus 6, which is a multi-asset high equity fund, and we'll also talk about our defensive fund, which is a CPI plus 4 targeted fund. Included in the lineup, I'd ask Rupert to talk about our global balanced portfolio, which also targets CPI plus 4. Rupert, how did 2023 work out for you?
Yeah, great question. So it's always about the competitive nature of our funds, and we get compared to other funds in the category as well as to our benchmark. Last year we finished ahead of both. We finished strongly ahead of the other funds in our category. We were one of the top funds in category for the 2023 calendar year. So that's an awesome tick box for us. But we also like to measure ourselves versus our composite benchmark. Now, our composite benchmark is what we see as the allocation of our peer group, but before costs and expenses. And that's a much, much harder hurdle to beat through time. And what we're looking to do with that composite benchmark is to earn back the fees that our investors are paying and try and match that composite benchmark. And we were very happy to finish the year ahead of that composite benchmark as well. So a strong year for alpha on both regards for our funds. Let's look into that performance that I've mentioned. So if we start with a simple index performance versus the ASISA High Equity Peer Group for our balanced fund since inception, a strong lead against the peer group. But for us, it's very important to look at ourselves on a percentile ranking basis over the last year, this being the end of the year, closing off the year of 2023 for us. And this is what we are so proud of. So if we look at the percentile rankings, 100 being the top, 0 being the bottom, we are well and above the midway point, which would be the 50th percentile. In fact, we're pretty close to being in the top decile for the year. So a very strong finish for the Prescient Balanced Fund through time. And that just compounds our thesis of this balanced fund in being above average more often than not. And that's illustrated by this bar chart here. What this shows you is the time that we've spent above average through rolling different time periods, so 3 months, 6 months, 1 year, etc. So top quartile being dark blue, and then so it goes all the way down to bottom quartile. What I wanted to show you here is if you spend more than half of your time above average, so top and second quartile, it compounds you all the way out to being above average over the slightly longer term period. So for an investor in this sort of fund, looking for a high growth type asset class or asset mix, you're looking at a 5-year plus horizon. And what this fund has done since inception, which is almost 10 years now, is to deliver more than the average performance of the peer group in a consistent manner. Switching now into the alpha decomposition of our flagship balance fund, important to track your allocations or performance versus the composite benchmark as well as the standalone performance. Where we saw big drivers was in the strategic asset allocations. So that's where we're structurally different to our benchmark, where we look to get a more efficient long-term portfolio allocation. That gave us around 1.5% of alpha. Looking at the tactical asset allocations, we had very few tactical plays in place last year. The three main ones being at a point we were overweight the rand. At 2 points, we were underweight developed market equities. And then the third trade was that for a large part of the year, we were actually overweight in the South African nominal bond space. The detractors there was primarily the underweight towards global equities, but Bastian's taken you through some of the reason as to why we were underweight offshore equities. In fact, we are underweight offshore equities again as we come into 2024. The primary reason, as I'll show you in our asset class views, is that US equities, after their very strong rally in 2023, are now at valuation levels even higher than they were coming into 2022, which makes it a very, very top-heavy market. So we're quite comfortable being underweight in the US equity space. Portable alpha, that's our contribution from our portable alpha overlays. It's fixed income alpha that we gain over the market. So simple alpha from the fixed income markets. That was a strong, steady 80 contributor of around 1%. And then the last one here is fees. Now, fees is always going to be a negative attractor. But what we see in the fee space is that our fee load at 35 basis points in our flagship funds, including VAT, only detracts 35 basis points from performance. You can just picture if that fee load was 1.5%, like some of the peers in the peer group, we would be 1% lower than we are at the end of the year. So a strong year for us in 2023 and something that we're quite proud of.
Thanks, Rupert. I think an attribution discussion is always key. But one of the beauties about webinars is that you have a recording of what you said. So reflecting on 2023 and our webinars, we've got you on record. How did some of those actions or considerations play themselves out?
Yeah, so this is an exercise that I do at the start of every calendar year. I go back and I look at exactly what we wrote in our commentaries and we said in our quarterly webinars. I think it's something that's very important to reflect and see where we went wrong, where we got it right. And I think it's important to say that 2023, we got quite a few things right. We went through our predictions on our soft landing, let's call it that, for the United States. There was no recession. Our Prescient Economic Indicator picked that up with a high degree of accuracy. And we also looked through the noise when it came to global economic geopolitics, and we've stuck to the numbers. You saw, despite having a war in Ukraine, tensions in the Middle East, global stock markets finished the year on a very, very strong note. Where we perhaps were a little bit wrong, if you want to call it that, was that we went underweight in US equities. But for us, we're very comfortable going into that space because we think that it's a very top-heavy market. So we've still got significant exposure to US equities and global equities for that matter, but it is a top-heavy market. It's a market which, going into last year, was sitting on a PE ratio of around 19.5, is now sitting on a PE ratio of 23 after a strong rally. So coming back to Bastian's earlier point, with growth sitting at around 2%, you need significantly more growth in global markets to justify valuation levels where they currently are. And what we're seeing there is that markets are essentially preempting the Fed cutting rates aggressively. The risk to portfolios in 2024 is that the Fed doesn't cut rates as aggressively as the market has been pricing.
Thanks, Rupert. Looking at the reports that come out talking about interest rates, I think US investors have had the benefit of high rates, and there's been a significant amount of money that's moved into US money markets specifically. So given the backdrop of everything you've said, the expectation is at some point the US will cut rates. There's just going to be a wall of money moving in to look for risk or yield pickup around the world, whether it's going to be in the US or outside of it. Given that backdrop, positioning, again, given the macro, how do you position the portfolio for 2024?
Yeah, so our portfolios are very much fixed income driven. We're a fixed income house, a large skill set sitting within fixed income globally. So we've got models around the world for rates and yields on different fixed income instruments. And I mentioned that it's important to differentiate between pricing, current pricing, and the way that the market actually turns out. So if we've got aggressive pricing for rate cuts going into 2024, and the Fed doesn't cut as aggressively as the market is pricing, it's actually a bad thing for markets across a lot of the different instruments that are traded. If the Fed cuts more aggressively than they are priced, then it's a good thing. But a lot of cuts are currently priced in. I think it's important to highlight, though, that the Fed has been engaging in quantitative tightening throughout this whole period, and it hasn't had significant material impacts on the markets. That's predominantly through the balance sheet of the Fed. And the second thing is that with rates so high, they've got room to cut. So I've mentioned this before, but if rates are at zero, the Fed doesn't have much choice than to quantitative ease. But if rates are significantly higher than zero, they've got that room to cut to stimulate the economy. So going back to Bastian's earlier point on labor markets and different growth aspects of our economic outlooks, if those turn and the Fed cuts in time, then it's actually quite a good scenario to be in right now. Just rounding off all that I've said, our summary of asset class views going into 2024. Some of you may be familiar with this table, but in the middle, when we're neutral in an asset class, we don't have a tactical view. It doesn't necessarily mean that we don't actually hold that position. We would generally hold that strategically, but we don't have any tilts on either side. When we're on a strong negative, we take an underweight. When we're on a strong positive, we take an overweight. But it doesn't necessarily mean, again, that we would go strong negative and take off all of our US equities, for example. We're not a flexible fund. We're constrained primarily to the anchor of our strategic asset allocation. Our view on South African equities remains neutral. There's a bit of a mixed bag there. What we're seeing here is that we've got a strong valuations case, which has existed for a couple of years now, but headwinds are starting to emerge in economic growth, both globally and also locally. Financial conditions remain mixed, as does sentiment, but that brings us to an overall view of a neutral. US equities, we've mentioned this a couple of times, we're currently strong negative. We're underweight on US equities in our portfolios in favor of fixed income assets offshore, which are offering a very high yield at this moment in time, so no complaints there, even at the front end of the curve. Valuations extremely negative in US equities right now. So having gone from an overvalued market to an extremely overvalued market, in particular because of a rally in the likes of the FANG stocks, which dominate the S&P and in turn dominate the MSCI World, we currently are cautious on global equities. Just shifting through the different asset classes in the mix, in the bond space, we've got a moderate positive on SA sovereign bonds, still a very attractive yield profile there, in particular for a CPI plus 5, CPI plus 6 type mandate. You're getting a yield profile of around 11% at the midpoint of the curve. So a very strong yield profile on South African bonds. And then in the credit space, we're neutral on South African credit. Linkers, we're also moderately positive. The Rand, we are still moderately positive. We're not in a strong positive as yet. We don't think it's going to strengthen significantly from here on out, but things do change, and that's important within this overall system. These can change day on day. When they do change, then we change the allocations within the portfolios.
Okay, thanks Rupert. That was a good review of the multi-asset portfolios and the positioning going forward. Going back to you, Bastian, the global macro, significant headwinds, considerations. What else might be around the corner that you haven't mentioned that you should certainly be thinking about because these are black swan events or something alike? Have you got anything in your mind that you're considering that you haven't mentioned yet?
It's always something going to happen which we didn't have in our mind, but I think we have enough black swan events mentioned already. Geopolitical risks, potential economic turning points, lower interest rates. So a lot is planned for already. So hopefully you're not looking for much more. What we do think at Prescient is a key consideration is we are starting off, exactly as Rupert said, from a level of very high interest rates, which us at Prescient, which should be benefiting us at Prescient, where we are a little bit more fixed income driven. And I guess it's important to piggyback on that. Don't bet on too many rate cuts, even if we think rates are going to go down, because a lot of that is already in the price. And don't forget your growth assets, because as Rupert said, if they cut more aggressively, it's good. If they cut less aggressively, it's bad. But we actually think that if they cut in line with expectation, it might not necessarily be neither good or bad. It might actually be good, because you do get more ripple effects. Your curve is less inverted. Financial conditions eventually are easier. So even if that's partly priced for, you might get a little bit of more economic momentum from lower rates. So a lot to look forward for in 2024. We feel well equipped. As Rupert said earlier as well, our Prescient Economic Indicator has an exceptional track record. We feel very confident that in a year where global growth and global inflationary trends once again will dominate market movements, we've got the right tool set, and we obviously at Prescient will continue to iteratively, bit by bit, improve the process. New indicators will come online, more data is going to feed the information processing which we apply, alternative data, new cool tools about to be released. So a lot to look forward to from our side. So please do watch this space. Thanks, Bastian. Maybe just to reflect back on what we've said is, in the multi-asset space, if we look across the savings industry in South Africa, there's been a significant shift back to balanced portfolios, particularly those that attract, or have a high equity allocation, and particularly at CPI plus 6 benchmark. I think the beauty of what we've seen from a returns perspective over the last couple of years is that these portfolios now have been able to beat their benchmarks. I think that's critically important from a financial planning perspective, because as we know, people often get to the retirement point underfunded, i.e. not enough money in their portfolios. And I think portfolios such as in the balance space, even global balanced, allows people to get a higher return. In addition, the beauty, of course, is that you have this diversification through the portfolio. And that done on an active basis by the investment manager, particularly at this point, Prescient, and being active as you've demonstrated is key for looking for those returns to ensure that the client's benchmarks are actually met. And I think that's a critical outcome. If we look at the data that we see out of ASISA over the last couple of quarters, we've seen the significant trend back to multi-asset high equity. Low equity, not as much, but certainly what I think is taking place is that people are seeing the benefit of multi-asset portfolios, high equity allocation, and the return delivery over time, which is supporting that financial planning process. So again, as I mentioned, from a flows perspective, we can see this is us tracking the CISA data. The category AUM has grown substantially. We've seen positive flows on a quarterly basis, which is good from an industry perspective and certainly supporting the CISA category as mentioned. And then,
ultimately the cumulative flows through time, again, indicating this point that, investors are allocating towards these portfolios because I think of the diversification and the ability that these funds deliver to actually support the financial planning process and delivering the returns that clients are looking for. So graphically, again, from a reporting perspective, we can see that the industry flows have been positive to the sector. I think one of the other critical points that we've seen, certainly the narrative coming through over the last couple of years, and again, we've seen it already, the conversations starting around costs. And really, what are the charges at a fund level? And I think the importance, certainly, of a Prescient balanced fund is that extremely well priced, but that also supports the return profile. And we think pricing a fund appropriately, particularly in times like we could be going into this year, with lots of uncertainties, that you need to have a fund that's well priced. Again, clients may be taking income from these portfolios, so a reduced lag on terms of performance delivery or ultimate returns being appropriately priced is an important consideration as well. Thanks, Bastian and Rupert, for your contribution and your insights. Folks, thanks very much for joining us, but we can take questions now.
Thanks, gents. Straight off the bat, one of the questions is really coming from a global perspective again, is we've seen this continued and heightened activity in the Red Sea. And the question around that is, how inflationary is this pressure on, supply around the world or trade around the world? Is this going to be significantly inflationary to the world? Any views on that?
Yeah, good point. I'll take that one, given that we have painted a quite benign inflation outlook, actually. So definitely good point, because that's the risk to the inflation outlook. We think inflation is going to come down this year, continue to come down and be quite benign, and with that low interest rate. So what are the risks to our view? And I think the conflict in the Red Sea definitely is one of those risks to that view. Having said that, we need to look a little bit deeper there. So first thing which comes to mind would obviously be the oil price. The oil price hasn't really reacted at all on this crisis. So actually, since the crisis in the Middle East evolved or started, the oil price has gone down. So it's actually lower. So the market participants don't seem to be too worried about that, to be honest. Secondly, also the Fed has a tendency to look through the oil price. So with that, again, we wouldn't be too worried about that. And then the second element, which is, I guess, a bigger thing, is the disruption of trade routes. So what does that mean for trade routes? And I think that's something we would be more worried. But just think about it. If the Red Sea would now really be blocked, trade routes would need to be derouted around the Cape. I don't think that that's something which would be lasting. So again, we would assume that market participants would see through that, as would the Fed. So yeah, long story short, could be disruptive, could be inflationary, but be mindful that not in COVID, where we didn't know how long this will last, a disruption in the Middle East, we think, especially when it comes to really blocking that trade route, would be more short to medium term to be honest.
So a lot more shipping activity around our coasts, which would be quite interesting. Rupert, one for you. Particularly around the uncertainties that we're seeing from an election perspective. What do those disruptions mean for your portfolio, and how do we see the pricing of this uncertainty in markets, and effectively, how do you manage through that?
Yeah, tough one. So we mentioned there are quite a few elections this year, the two primary ones being South Africa for ourselves, and then also the United States. South Africa is in May, late May, early June, date yet to be confirmed, and then the United States is in November. What we are seeing is, in essence, not much by way of pricing of risk. We look at option pricing, and we're seeing levels of option pricing which don't infer much by way of market implied risk. So that's an interesting observation. It's something that we think is perhaps a little bit too complacent in nature. So again, back to the diversification, better to not have all your eggs in one basket, given that there is such a high concentration risk to those particular two events.
Okay. Bastian, you indicated in your macro segment and from an allocation perspective, the question is, being underweight the US, is that not a risk given what we've seen from Magnificent Seven powering ahead again this year? Being underweight US equities in the portfolio, is that not a risk to performance this year?
Always a risk. So I guess underweighting US equities, especially if you look at the performance of the equity index over the last years, one of the strongest equity markets in the world, pretty much other than COVID, straight line up. So it is risky, but I want to say that our bets are measured, and with that we are able to take that bet. And secondly, I also want to highlight that there are forces which are really pulling heavier against the States this year than last year. We have a massive valuation gap. So the US market being way more expensive than early last year, or late last year, if you want to put it early last year, and emerging markets being way cheaper. So that's one factor. And the other factor also from a sentiment point of view. So we look at investor sentiment as well as one of our contrarian indicators. I guess the world has never been more negative on emerging markets. And often, especially if you look into the tech landscape, and the whole talk around artificial intelligence, etc., almost never been more positive on the US. So there's a gap from a valuation point of view, there's a gap from a sentiment point of view, and with that, there's quite a bit of room actually for a little bit of a reversal.
Okay, great. An important question around the asset allocation that we're seeing in balanced funds. There's quite a dispersion between participants in the space around the offshore versus the domestic component, and being able to utilize your full offshore allocation or not, or at a particular timing, I guess when those valuations look appropriate. Rupert, the question is, what do you expect from, well, I guess certainly the balanced fund and the global balanced, but particularly balanced fund domestically, where we've taken a large amount of money offshore, and parallel that versus funds that maybe haven't. What are you expecting for the year?
Good question.
Given the allocation.
So last year we saw a bifurcation in returns. We saw some managers who did take significant offshore exposures. They did pretty well, ourselves included. We're at 45% exposure in both our balanced and defensive funds. And then we had managers who didn't take as much offshore. And that might be because of structural reasons, like there are South African-centric managers with specialists within the South African stock space. But I think that just opens up the opportunities for, in particular, fund pickers going forwards to really split the multi-asset high equity category into different types of managers, right? You've now got South African specific specialists, and you've got global generalists. And I think within this particular category, it's perhaps best, this is a personal opinion, of course, but to go with a generalist, someone who's got a lot of skill sets under their belt. And for us, that means that we can trade both onshore and offshore to the same degree of confidence, right? We don't have stock pickers on the ground in either of those jurisdictions, but we don't need to, because we don't pick stocks, right? So that just leads me into our global balance fund. Global balance fund offered in a feeder fund and a UCITS format, something we're seeing quite a bit of interest in of late, those who are looking to take more offshore exposure. And really, it's the same process as our balanced and defensive fund. It's the same infrastructure. It's just a different opportunity set, primarily based in global equities, including developed and emerging markets, and then fixed income across the curve in different geographies.
So a global balanced is a great idea. I mean, I think typically what we've seen in the South African context is people have taken money offshore and invariably ended up in equity-centric portfolios. Yeah. So to have access to global balanced via a manager, I think there's a great benefit. So expectations there that those asset classes that we've backed are going to deliver the returns this year, which is great given the macro backdrop and positioning. Bastian, maybe just last one for you then is, rate cuts around the world. The Fed is poised to potentially make a rate cut decision coming up. What gives us confidence around that, and maybe how deep you see those cuts coming, and what effect does that play on the portfolios?
Yeah, good point. Let's start with inflation on that one. So we're quite confident that inflation will come down. Obviously, there was a very good question on the Red Sea and the risk thereof, which we've covered, I guess. But excluding that, we think inflation is going to come down for three reasons. A, for cyclical reasons, we can see that the labor market is continuing to weaken and wage growth is coming down. B, for structural reasons, we always tend to forget about the long-term structural deflationary forces like aging populations, more indebtedness from governments, and rise in productivity and robotics, etc. So a lot of reasons why there's long-term deflationary forces at work. And the last but not least, if we really dissect inflation, we can see that the housing market or the shelter component is the only driver, while the housing market is starting to look weaker. So even if you look what's driving inflation right now, it looks like it's supposed to come down. So with that, definitely lower rates this year. When is it going to happen? For that, we have to look at market pricing. Also, is it the same going to happen in SA? So in the States, market pricing tells us it's going to start happening in May. March, the first cut is not fully priced. So probably the Fed will go with market pricing here and just wait a little bit longer, which also is a risk, to be honest. But that's probably what they're going to do. But then in May, it will be very hard for them not to cut. So let's say May interest rates come down. What does that mean for the SARB? Definitely, they're going to follow. We are very confident around that. Yesterday, we had an inflation print, again, surprising on the downside. We had 2 monthly inflation prints surprising on the downside now. 2 monthly inflation prints together actually being deflationary, which is quite a thing in South Africa. So you don't see that often. And the core inflation at 4.5 came in again right at the middle of the band. So we can afford to ease. So why are we so sure that we'll follow the Fed? Well, look what happened on the way up. So on the way up, when the Fed embarked on the super steep hiking cycle, we decided to follow, which wasn't a no-brainer. It was a no-brainer for the Fed to hike. They were behind the curve. They had a lot of inflation and they had a super strong economy. Was it a no-brainer for us to follow? We don't think so, because we did, we had better contained inflation in South Africa, and B, we had a super weak economy. So no reason from that point of view to necessarily follow. Yet we followed on the way up. So if the Fed now comes down, no doubt that if we follow them closely on the way up, we will follow them closely on the way down, and inflation is really well under control in South Africa. So no reason not to follow down.
Great. Thanks very much. Folks, we haven't got any more questions, so thanks very much for participating. I think importantly, we've ended this discussion on a rates front, and next week, Monday, we've got our fixed income portfolio managers talking about their portfolio. So in a rate cutting environment, how does that affect income funds specifically? So please join us on Monday. But thank you for spending the time with us today. It's always good to be able to share our insights and views, and we look forward to engaging you, if not on other webinars, in person during the year. Thanks very much, everybody. Have a good day.
Thanks.